Welcome to a transformative moment in the world of investing. Picture a timeline that stretches back over 2 centuries, rooted in the ethical principles of religious communities like the Methodists. Leap to the 1960s, where the civil rights movement and anti-Vietnam protests gave socially responsible investments, or SRI, its voice. The first Earth Day of the 1970s turned our gaze toward environmental stewardship, while the 1980s saw investors rallying against apartheid in South Africa. Fast forward to the 21st century, and the narrative has evolved. We've moved from merely avoiding sin stocks to embracing a holistic approach known as ESG, environmental, social, and governance factors. The market has responded, surging from $2.83 billion in 2015 to an astonishing $17.67 billion by late 2019. Today, as we grapple with the existential challenges like climate change and social inequity, SRI stands at the forefront, offering not just financial returns, but a chance to shape the world. So as you contemplate your next investment, remember, you're not just growing your wealth, you're crafting a legacy. Okay. How's Laura's audio? Is that working? Okay, so maybe not yet. Bruno, can you kick us off? Can you talk a little bit about how the public securities, like the measurement framework, how that has evolved over the years?
For sure. So let's start by saying that, when people talk about impact in the public equity space, that's kind of a complicated concept. The Global Impact Investment Network says that for something to be an impact investment, you have to have intentionality. In other words, you have to actually have intended for something to happen. You need to have measurability and verifiability. And most importantly, you have to have additionality. So this is easy in the private equity space, right? If you put up the money to improve a community's well water, well, it wasn't there before you showed up. It's there after you put up the money, and you can easily measure what happened afterwards. But if you own a portfolio of public securities, that's not so easy. And one of the things that I was involved with at UBS was actually building a portfolio of public securities for a very large Dutch pension fund that had the desire to create impact. And what we did is we started out by defining a universe of companies that had products and services that had external impact. In other words, products that actually had a net effect on water, or that reduced pollution, and so on. And then we partnered with academic institutions like the Harvard School of Public Health and the New York University's water team to devise metrics by which we would measure what the company's products actually did. And then we had a very vigorous engagement program to create additionality. But it's fair to say that when you're talking about impact in the public equity space, it's a real cutting edge area. Most people, when they're starting to talk about impact in the public equity space, are often really referring to ESG. And I like to differentiate between the two by saying ESG is first and foremost something that goes on within the 4 walls of the public company that you've invested in. It's how the board is composed, it's how the company uses resources, it's how it treats its employees. And you could have, a positive ESG sustainable candy bar company. That's an extreme example, but you get the t-shirt company, let's say. Uh, but you couldn't claim that the product generates any particular impact. Whereas, let's say you invest in a company that produces water filtering systems for communities in Latin America, you could pretty easily figure out what's the impact and start to measure it. So the products and services that you choose in the impact space is really important. And you need to have engagement, because at the end of the day, you have to create additionality for it to be credible. So that's the world of public equity's impact. It's kind of a far out sphere of investing, but I was very proud to have been a leader in that space.
Debra, the MacArthur Foundation has really been at the leading edge. How has its investment strategy evolved over the years? She may be frozen. So we'll go to Kevin, who built a program. Can you share what that looked like from the time that you started and how that evolved?
Sure. The New Hampshire Charitable Foundation is one of nearly 1,000 what are called community foundations, unlike the MacArthur Foundation, which is a private foundation set up by a family. A community foundation is a collection of philanthropic funds that operates under a nonprofit umbrella. Those funds are pooled, invested, and then about 5 to 6% of the proceeds every year are distributed in the form of grants to support community benefit activities, usually in the nonprofit sector within a particular place. Our place was the state of New Hampshire. And essentially what we're doing in our traditional model is that of the 100% of capital, the philanthropic capital that we were using, only 5% was directed to the activities that really our organization was committed to, whether it be housing or the environment or sustainable food or any other number of issues. So the question was what to do with the remaining 95% of that capital. And over the years, we had made a few investments that happened to touch down in New Hampshire. We made some forest land investments. We helped to create the Community Development Finance Institution called the New Hampshire Community Loan Fund, which loans to low and moderate income individuals for housing and childcare and workforce development. But we never had a comprehensive strategy. So we looked at a way to take about $10 to $12 million of the overall portfolio, which at the time was a little more than $500 million, and devote it to investments that would touch down in New Hampshire, would benefit the people of New Hampshire, and give us a reasonable return. And we used a similar strategy that any other investor would do, a combination of private equity, public equity, fixed income, and other specialty sorts of loan activities. And since we started the program at the Charitable Foundation in 2017 with $10 million, the foundation has now adopted a more robust impact investing approach across its entire portfolio, which is now approaching $1 billion.
So one who has interest in investing with purpose, it is like multi-asset class. It's thinking about publicly traded stocks, bonds, and then there are other places too. Since you mentioned, it sounds like commodities, if like forestry, different areas.
Yeah, that's right. There are a variety of ways to achieve impact. The forestry example is a pretty good one. This was a case where we actually had a timberland investment company that was based in New Hampshire that was interested in securing private forest land and making sure that the harvests there were sustainable. And then in many cases, using some of the capital to actually, or generating capital by selling conservation easements, permanent conservation easements to a public entity of some sort, a statewide conservation group, the federal government, or another national group, so that that land stayed in forestry and in sustainable forestry in perpetuity, and therefore could generate products, could generate jobs for local loggers and forest products processors, et cetera. So it has by making an investment in that sort of timberland, you could ensure that there was a sustaining economic value in the place where that forest land was located, and not have it all be, shift off to some other place or to the investors from Wall Street who might be interested in a profit, but might not be as interested in what happens in the local economy.
Debra, the MacArthur Foundation has been leading edge. So can you share a little bit how your investment strategy has evolved? And I'm curious what cutting edge looks like at this moment.
Well, thanks, Andy. And cutting edge is not my hotel internet connection. So if I cut out again, I'm just going to turn off my camera. You know what I look like at this point, and hopefully that'll work. MacArthur Foundation is a global philanthropy headquartered in Chicago. We have offices in India and Nigeria. We have major grant-making programs that include climate solutions and criminal justice reform, journalism and media, and a commitment to our hometown of Chicago itself. A new initiative focused on local news that you may have read about, and we have a flagship MacArthur Fellows program, which announced a really extraordinary class of fellows just earlier today. So, at our core, we are a philanthropy, but for 40 years, starting in 1983, the foundation has used impact investments to extend the reach and deepen the impact of our work. So we do not use impact investments in every single area of our programmatic work. We take what we call a problem first, tool second approach. So we look for situations where a catalytic impact investment strategy can really add value to our philanthropic and impact goals. Historically, that has meant major support in the earliest years of the community development financial institutions, or CDFI field. We had a 20-year initiative in affordable rental housing that was national in scope. We've been working in our hometown of Chicago with not only grants, but impact investments for a very long time, supporting affordable housing, business development in marginalized communities, and support for developers and entrepreneurs that are people of color and women who have historically faced significant capital access challenges, as is well known. So a wide range of activity. As you noted in the intro, we sort of see equity, inclusion, and sustainability as the broad umbrella for everything we do, but the work itself is highly targeted and specific to really the kind of additionality that was described earlier. We are looking specifically to fill the gaps that conventional investors, less risk-tolerant investors, more profit-minded investors can't or won't serve. So is there a situation where a small business entrepreneur is trying to get growth capital so they can meet the opportunity of today's infrastructure investments and green investments from the federal government, which are historic, unprecedented opportunities, but they lack the working capital to be able to compete for those contracts and to be successful. So there's a gap that if we can come in and help find a solution, a market-based solution, but one that really allows those entrepreneurs to build up their scale, capacity, credit, and track record, then they can move into competing more effectively in this large opportunity space. So that's just one example where there may be gaps that are transient, that we can come in, help an enterprise, a nonprofit, a for-profit, help a fund innovate, build a track record, scale, attract more capital. Maybe they're going to be attracting fully commercial market rate capital. Maybe it's a mix. We do not see it as a one size all. The capital that is needed to address the world's problems spans a spectrum. And that spectrum ranges from the impact first type of approach that we can take by virtue of our flexibility being a philanthropy. It spans from impact first all the way over to finance first. And as was noted, ESG, investing in public equities, that's really on the finance first end of the spectrum. And we need that capital too. The problems are immense that we face. The needs to address the sustainable development goals are in the trillions and trillions of dollars. But often what we really need are solutions that harness and pull together all those different forms of capital, each playing the roles to which they are best suited.
Debra, do you view those types of investments as higher risk and potentially higher return?
So the risk return profiles really vary depending on the sector and the nature of the problem. What's the nature of the capital gap itself? So in some cases, the investments are lower return than an ordinary investor might be looking for say, an illiquid 10-year private loan, with no collateral. But we know that the risk history of CDFIs and the performance has been very strong. So those are lower return than they might ordinarily seek, but the risk as well is lower. In other cases, the risk, because you're investing in very, very early stage breakthrough energy technologies, that risk might indeed be higher. I mean, as consistent with a seed stage, highly innovative investment. But the return potential could be quite a bit higher. And then we see everything in between. So I don't think there's a generalization. I know there's a lot of debate about, whether impact investments have trade-offs or don't have trade-offs. We really think we need to be beyond that trade-off conversation. It really needs to be about the additionality. Is it a gap? Would the impact, would the other capital happen, but for the impact investment that we are looking to make? For us, it's the but for piece that is really decisive. That's our form of impact investing. And what I don't want to suggest is that that needs to be everybody's form, because we partner with institutional investors, we partner with government, we partner with nonprofits. So we need to have, with family offices, we need to have a more inclusive view of what it means to do impact investing.
Do our panelists have anything to add? Otherwise, we'll move on to segment 2.